Hey, welcome back. SQM is the number one lithium mining company by production with operations in Chile, Australia and China. A main advantage is that they have a very low production cost, being able to make a profit or stay afloat even when the price of lithium is down. They see the demand for lithium growing by 20% this year, but due to the market's dynamics, the price would remain stable. The company estimates CAPEX of 2.4 billion in 2024 and 25, most of it being related to lithium expansion. If you look at the inventories and cash, they basically have all the money they need, so even if they won't make a lot during this time, they should be able to finish these projects. Or if they want to, they can also get a bit of debt, which, as you can see in a second, is totally fine. They have current assets of 5.8 billion, which is almost enough to cover all the liabilities, so they are in a very good financial shape. So, based on the company's estimations, the cash flow should most likely be negative because they are investing so much. But in a normal year, they are going to need something like 250 million in maintenance, so even with lithium at half the current price, they shouldn't do so bad, but more on this in the valuation. Again, like a majority of lithium companies, they invested a lot recently thanks to the higher lithium prices. Following these investments, they should reach a production of around 260,000 tons next year, still being the number one producer. One thing that Albemarle has pointed out is that the current lithium production, even with a massive increase recently as everyone is investing, still won't be enough to offset the demand. In such a scenario, lithium could even break the previous record. So this can be very beneficial for the price, but on the other hand, it can incentivize a replacement. You know, I talked about this in more detail before, but simply put, there is a lot of money put into researching more efficient batteries. Now, one thing that I like about SQM is that they aren't just a low-cost lithium producer. They also produce potash, for example, which is key in the fertilizer industry. So you get a very cheap lithium plus something that's generating a bit of a more constant cash flow. As we can see recently with lithium prices crashing, that's very useful to have. A downside is that they have to pay a lot to Chile. We can see the royalties and other duties paid recently, but on the bright side, they are very competitive even with them. This is also an advantage because it's a barrier to other companies, since the country is not just handing out the mining permits to everyone. They recently announced a deal with Codelco, the state-owned mining company, that would allow them to mine for a lot more time and increase capacity, but they'll have to split the profits. Again, this has its positives and negatives. I'll say it again, with lithium companies, a big issue comes from the big miners. These companies are 10 or 20 times bigger and make in a single normal year enough to buy a company like SQM. We can see Rio Tinto, for example, casually investing like $1 billion in a lithium mine, while for SQM that's the whole CAPEX after a couple of incredible years. It can be good if they want to buy a lithium company directly, but otherwise it's simply impossible to compete with them. Also kind of related to that, China taking more and more of the market, both the supply and the demand, puts SQM and other lithium companies in an interesting spot. You know, lithium itself isn't that rare, but cheap lithium is. This means that what SQM owns could see a lot of interest in the future as the average cost of production of new mines goes up. So I think the chances of lithium companies like SQM to be bought by a company like BHP, Glencore, Rio Tinto and so on should be pretty high in the long term. Now, the dividend payout ratio depends on two very important financial indicators. Basically, if the company is doing very well, you can get up to all the net income, which can be very significant in good years, as we saw recently. If they aren't doing so well, you get at least half and they use the rest to improve. We can see the past 2 years, for example, when they pay the equivalent of 10 and 15% today. And they also did pretty significant buybacks a year ago. But before the price of lithium exploded and the company was much smaller, they were paying around 3% on average. However, that is if you buy today, but if you got it for 25 for example, that's close to 6% even before the good ones. So you can see why buying this for a good price, like many other commodity stocks, is very important. Now, this is obviously going to depend on the economy and the EV industry in particular. Cars in general are very susceptible to a recession, meaning that SQM and other lithium companies should also be very vulnerable. And again, that's if lithium will keep being a significant component for the batteries, because there is the risk of lithium being replaced. But even if it happens, low-cost producers like SQM should probably still survive and might even do well. On the other hand, if it isn't replaced, then lithium has a very big chance of doing very well in the future, so you have to balance the risk and reward. Again, this is a matter of supply and demand. As for a valuation, let's look into the classic 3 scenarios based on the commodity cycle. In a negative case, with lithium around 7000, they can probably make around 350 million based on the new production, depending on the CAPEX. For a ratio of 10, that's 3.5 billion, meaning a price of around 12.2. That's a 75% loss from the current price, and it's pretty similar to the low from a decade ago. Now, this can fall even more depending on the market. I mean, a ratio of 10 is still pretty high, but I think this would be a very reasonable low to assume considering lithium's potential. Plus, if there is a recession, we can see them fall to this price even if lithium doesn't. On the bright side, the average dividend if I buy at such a price would be very impressive. In a second scenario, with lithium around 20,000, they should produce something like 1 to 1.5 billion. For a ratio of 10, that's pretty much the current market cap, so a break even. So you can see that from the current price, there isn't that much potential in 2 out of 3 scenarios, so by default I'd say this is not currently a buy. In a good scenario, with lithium at 50,000, they should make around 2.5 billion depending on the CAPEX. Assuming a ratio of 12, that's a market cap of 30 billion, meaning a price of roughly 105. That's actually very similar to the company's peak and pretty much a 2x from the current price plus the dividend. Sure, if there is hype and market hysteria again, the ratio can be even 20, making this even a 10x if bought at a low price. I'd say this is not really a buy for me right now, but for something like 25-30, this would be very attractive. That would be a potential 4-5x plus a very attractive dividend. So overall, SQM is a pretty good lithium company for me. Great financials, cheap and very significant production, competitive advantages, good dividend policy, and overall a good company. Maybe not at the current price, but this together maybe with Arcadium and Lithium Argentina would be my picks from the industry. I have videos about all of them and other lithium companies, so make sure to check them out as well. In a recession, this would be even more interesting and they would definitely have a spot in my portfolio. Again, can the price of lithium fall even more? Yes, but at least I'm ready, and if that happens, I know when to buy. Still, when investing in lithium, you have to keep in mind the risk of it never going above 20,000 or even 15 ever again. What led to the previous spike was a lot of market hysteria and uncertainty, making it basically perfect for the price of lithium. With new technologies being constantly developed, there is a serious risk of replacement that can disrupt many commodities, including lithium. Still, again, SQM would be among the companies that would do well even if that happens, but you have to be aware of the possibility, especially when investing in other companies. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.